that in order to forecast income statement, we made 3 sheets: income statement notes, and assumptions. Assumptions will be used for all the forecast income statement, balance sheet, and all that. IS notes is specific to income statement. So in income statement, we first put in past data. Then we made some KPIs or a table for key performance indicators. Then we started with first item, sales. We decoded sales in IS notes and we forecasted the sales growth. For forecasting sales growth, we needed some assumptions. So we put those assumptions in assumptions sheet, like for example macroeconomic assumptions. So we took assumptions from there, linked it to forecast of sales growth, and we linked, based on this forecasted sales growth, we forecasted sales. Again for COGS, same thing happened. So for COGS, we forecasted COGS rate in IS notes based on sales forecast. In addition, we added another variable to account for companies' initiatives or performance or savings and all that, and then we pulled it here on income statement. Again, then we moved on to SG&A, and then we moved on to tax and others. So the idea was, on income statement sheet, the sheet is very clean. It just shows me income statement. It does not show me any workings or breakups or decoding should be done in IS notes. If there is anything which you think is an assumption and can be changed later, or which you would want to change in later to see the impact, then that goes in assumption.
Can you go back on that slide where you were writing down?
So macroeconomic assumptions or any other assumption, CPI assumption or real GDP assumption so far. As we go ahead, there will be more and more assumptions being added to assumption sheet. So the idea is that we started with one sheet, and now we are adding sheets to the model as and when need arises. And as we go ahead, assumptions will continue to be added. IS notes are done because they have already been incorporated into income statement, and income statement forecast is complete. So whenever you are forecasting income statement in your model, key things are that do not show workings on the face. It is not advisable, otherwise it will make it confusing, because someone looking at income statement would want to look at income statement. Have a KPIs table below, so that if someone wants to look at it or wants to look at the past and future trend, then you should be able to look it at KPIs table. So if you look into it, gross margin looks stable, shows a stable improvement. So 47.6, 49.6, 49.7, 49.8, 49.9, 50, 50.1. Why? Because our assumption was that company will manage its savings or drive efficiencies in such a way that it is able to stabilize the gross margin. If anything unusual comes on company's way, like for example, if raw material prices increases, company will pass it on. On average, there should be continuous improvement or continuous or stability. So gross margins are pretty much stable. SG&A stable, operating margin changes due to leverage, tax percentage, net margin, earnings growth. So this is how we have forecasted it. Any assumptions can change. Every analyst would have a different assumption. So any assumptions can change. Any values can change. Any forecast can change based on the analyst himself. So this is the first part, which is forecasting income statement. Any problem or confusion so far?